it works. So just before we move to the second panel, I would like to present shortly the findings of Better Finance report on the real return on long-term and pension savings. And it's going to be short. The full presentation is online, and also for everybody who would like to have a more of a deep dive, we had the launch of the pensions report on the 6th of November, and on our website you can see also the full presentation and also a deepened Q&A for that one. So when we go over the study, the presentation, I will present very quickly the findings for the last year, so 2023, the long-term perspective, and then a bit of focus on asset allocation and the costs of the second and third pillar, and the policy recommendations. So as you can see, we by now are covering 16 EU member states and look at 48 categories of long-term and pension saving products, to public funded pensions, 21 occupational, and 24 personal long-term pensions. We are able to gather by now up to 24 years of data. Data is still a problem, and it becomes increasingly a problem. Some of the we are using only publicly available sources, and by now some of the also public authorities do not publish some of the data anymore. So when you look at the year 2023, this was not a bad year, you could say. You had a median nominal return after charges of 10.1%. With inflation receding at an average of 3.4% across the EU, and the adjustment of for inflation would leave you with something around 7.4% of the real net return. And this is, of course, in contrast with the year 2022, which was much worse, and was much worse in terms of inflation. But as already very rightly said and underlined in the first panel, when you save for retirement, you really should not focus on any particular year. You should look at the long-term results. And when you look on the long term, it does not look that great. Sorry, it's going to be a bit quicker version. So the long-term version, the long-term view is not that great, in fact. And when you can see, when you look at the 10-year annualized nominal performance after charges, it stands only at 2.93% per year. But then when you want to also to adjust for inflation, you can see that the result is much worse. And in fact, you can see that most of the pension products were barely able to really maintain the purchasing power of investor savings, with the median real net performance of only 0.6%. Then when you look a bit closer into our report, you can find two, you could say, ugly graph, and they are not ugly because of the aesthetics, even though maybe not everybody likes them, but about the content. The content is really not great when you are a pension saver. And in fact, you can see that among the products that we have analyzed and computed the returns for, you have some products that stand out. And we will mention this. This is AP7 SAFA. It was already mentioned also, I think, in the first panel. It's the Swedish pension product. And in fact, this product was able to perform a bit better and also provide better outcomes from the Swedish pension savers. And when you look at the cumulative performance, the gap between the Sweden's premium pensions and the rest becomes even more dramatic. So when the Swedish workers, who basically did not have to make any decision regarding their retirement savings, got the savings multiplied by over 4 times over 23 years. It did not look that well for pension savers in other countries. You could ask what AP7 SAFA does right. Well, it implements a life cycling approach, in fact. This was also touched upon in the first panel. So you get fully invested into the world of equity markets until 10 years into your retirement, and then progressively it transfers you 2/3 of your investments into bonds, but still keeps you into equity for 1/3 of your accumulated assets. So this approach seems to pay off. And then you could ask what the others do wrong. And in fact, when you look at the most products, you see that they lag behind capital markets. And this is actually the case for 34 out of 48 of the product categories that we have had a look at. So one possible answer to the question what is wrong with the rest of the product would be the bias and the fixed income bias. We talked about it a bit, and we had a look at that, and it really seems that there is a bit of correlation when you look into what exactly the products are invested. Then the second driver, and we also talked about it already, is the cost. It seems obvious for one part, but however, it gets often overlooked. And when we talk about the cost, we sometimes also hear from the industry participants, financial market participants, that we focus too much on cost. But you can in fact observe that there is really a structural gap between the cost of occupational pensions and those of personal pension products, so between Pillar 2 and Pillar 3. And in fact, the dark blue line in the graph shows the median value across the average cost of occupational products in our study. And you can see that it has generally remained below 0.5% of assets per year. And in 2023, it was standing at 0.28%. And by contrast, the median of the average cost of Pillar 3 products has consistently remained over 1%, closer to 1 point until 2007, and then soaring until 2016, until it reached its current level of 1.08%. So it, of course, impacts performance in different ways. And when you compare the nominal 10-year performance of the 3 pillars, you can see that the occupational pension as a whole have generally a superior performance in terms of Pillar 2. And when you look at this after adjusting for inflation, you find the same performance gap, with inflation, of course, worsening the outcome to the extent that the half of voluntary products return a loss of purchasing power over 10 years. And occupational pensions are not immune to that, but at least most of them manage to offer a positive real return over that period. And then at least one personal pension product in our study did offer a very good return in 2023 and charged only 0.72% of asset per year. And this was in fact already the product that we mentioned in the first panel referred to. So this was the PEP offered by the robo-advisor Finax in Slovakia. But as we already mentioned, there are many different problems why this product is not offered actively in other countries. So we believe that the findings prove that definitely there should be still done more and better reporting. So access to data is really crucial, and also access to data about the cost and returns for pension savers is really crucial. If you want to encourage them to invest more, they need to definitely have this information. The first panel already talked a bit about the distribution of retail investment products and also about the conflicts of interest that still persist, that the retail investment strategy did not manage so far to tackle. We would like also to have really better information to investor and more transparency, better sustainability information also touched upon already in the first panel. To end the fixed income bias, we would like also to see the end of penalizing taxation of pensions. This was mentioned by Jan Sebo, and in particular, of course, this is right now concerning the PEP and how it is treated in different member states. And you can also have a look at the opinion and the paper produced by the Occupational Pension Stakeholder Group of EIOPA, where we looked at different reasons why PEP did not so far take off. And in fact, it's also a very clear finding of this paper that 1% fee cap is not the biggest problem. We are also wondering, and we have some recommendations of how auto-enrollment in Pillar 2 could help with improving the situation of savers. but also we point into the possibility and allowing for pension savers to suspend their contribution for some time when they go to some financial difficulties, instead of giving them the only alternative to just stop saving at all. And one final recommendation concerns insurance guarantee scheme. So I am conscious of time and we have a bit of a delay. So I would right now invite the panelists from the second panel to take the seats. And we would start with a statement from Dana Bachmann from the DG Employment.